Are you noticing how loudly everyone is celebrating crypto again, almost as if the last collapse never happened? That excitement is exactly why caution matters right now. Every major crypto downturn started during moments that felt optimistic, confident, and full of promise. Prices rise, headlines turn positive, and suddenly risk feels invisible. But markets have a habit of humbling people when confidence grows too quickly. In this video, we're cutting through the noise to look at why the current hype may be far more fragile than it appears. This hype always peaks before reality sets. In crypto, hype builds quietly at first, then suddenly feels unstoppable. That's the phase where caution disappears. Social media fills with success stories, price targets, and confident predictions. What's missing is balance. Hype convinces people that risk no longer matters and that downside is unlikely. Historically, this is when markets become most fragile. Prices stop rising because of value and start rising because of belief. Once belief wavers, momentum reverses quickly. Many past collapses didn't start with bad news. They started with unrealistic expectations. When reality fails to meet hype, the exit door becomes crowded. That's why hype is not a signal of strength, but often a sign that vulnerability is quietly growing underneath the surface. Liquidity looks strong until everyone needs it. Liquidity feels abundant during rallies, but it often vanishes when it's needed most. In crypto, liquidity is especially fragile because many participants rely on constant inflows of new money. When sentiment shifts, buyers step back and sellers overwhelm the market. This imbalance leads to sharp drops that feel sudden but are actually structural. Liquidity doesn't disappear randomly. It retreats when confidence cracks. Past collapses accelerated when markets realized there weren't enough real buyers at higher prices. Order books thin out, volatility spikes, and price declines feed on themselves. The danger isn't low liquidity today, but the assumption that it will always be there tomorrow. That assumption has failed repeatedly. Leverage is quietly building again. One of the biggest hidden risks in crypto is leverage, and it's creeping back into the system. As prices rise, traders borrow more to amplify gains. This creates artificial demand that pushes prices higher than fundamentals justify. The problem starts when prices stall. Leverage doesn't wait patiently. It forces liquidation. Margin calls trigger automatic selling, which drives prices lower and causes more liquidations. This chain reaction has powered nearly every major crypto crash. The market doesn't collapse because people change their minds. It collapses because leverage removes choice entirely. When borrowed money unwinds, speed replaces logic. That's why leverage buildup is less visible than hype, but far more dangerous. Artificial intelligence is not a safety net. Artificial intelligence tools are increasingly used to analyze crypto markets, but they don't eliminate risk. Many investors believe smarter algorithms mean safer markets. In reality, artificial intelligence reacts to data. It doesn't understand human panic. When markets turn emotional, models can amplify trends instead of stopping them. Automated systems respond to volatility thresholds, not common sense. If prices fall rapidly, artificial intelligence-driven trading often accelerates selling rather than stabilizing it. The danger comes from overconfidence. Tools are helpful, but they don't replace discipline. Past collapses showed that sophisticated technology failed to prevent disaster when human behavior shifted suddenly. Artificial intelligence doesn't break markets, but it can make crashes unfold faster than expected. Correlations rise when fear appears. Crypto investors often rely on diversification, but that protection weakens during stress. When fear enters the market, assets that normally behave differently start moving together. This rise in correlation makes losses feel unavoidable. During previous downturns, coins with unrelated purposes fell simultaneously. That wasn't coincidence, it was emotion. When investors rush to exit risk, distinctions disappear. Everything becomes something to sell. This collapse of diversification signals systemic stress rather than isolated problems. It's one of the clearest signs that hype has overpowered fundamentals. When correlations rise sharply, markets shift from selective selling to indiscriminate selling. That transition has marked the beginning of some of crypto's most painful declines. Confidence can break faster than prices. Prices don't start crashes, confidence does. Once people begin doubting stability, behavior changes instantly. Participation slows, risk appetite shrinks. and hesitation replaces enthusiasm. Even without major price drops, this shift weakens the market's foundation. In crypto, confidence is especially important because value relies heavily on perception. Past collapses accelerated after small cracks in trust went unaddressed. People waited for reassurance that never came. As uncertainty grew, selling increased, not because fundamentals collapsed, but because belief did. When confidence breaks, recovery becomes harder and slower. That's why watching sentiment matters more than watching charts. Markets can survive bad news, but they struggle to survive lost trust. Regulatory pressure has not disappeared. While hype focuses on growth and adoption, regulation remains an unresolved risk. Governments tend to act during periods of instability, not optimism. When markets overheat, regulatory scrutiny increases. Past crypto downturns were amplified by sudden policy changes, enforcement actions, and legal uncertainty. Even rumors of regulation caused sharp price reactions. The current environment hasn't removed these risks. It's just ignoring them. That complacency is dangerous. Regulation doesn't need to ban crypto to hurt prices. It only needs to disrupt access, liquidity, or confidence. When markets are priced for perfection, even mild regulatory pressure can trigger outsized reactions. Ignoring this history is a costly mistake. Retail enthusiasm often peaks. Too late. Retail investors typically return near market highs, not lows. When excitement becomes mainstream, it often signals maturity in the cycle. Past collapses showed that widespread retail participation increased just before major declines. This isn't because retail investors cause crashes, but because they arrive when risk feels low. Unfortunately, that's usually when risk is highest. As prices wobble, emotional reactions lead to panic selling, reinforcing downward momentum. Institutions often anticipate this behavior and reduce exposure earlier. Retail enthusiasm feels like confirmation, but it's often a warning. When everyone feels confident at the same time, markets become less resilient, not more. Timing matters more than excitement ever does. Long-term narratives don't prevent short-term damage. Crypto supporters often lean on long-term narratives during hype phases. While innovation may continue, markets don't move on vision alone. Short-term dynamics can overwhelm long-term potential. Past collapses didn't disprove crypto's existence. They crushed overexposed investors anyway. Strong narratives didn't protect portfolios from sharp drawdowns. Believing in the future doesn't justify ignoring current risk. Markets punish timing errors even when ideas are sound. The danger comes from confusing belief with immunity. Long-term optimism should encourage patience and caution, not reckless exposure. Every cycle reminds investors that promising technology doesn't prevent painful corrections. Timing and discipline determine survival long before long-term success arrives. Fear spreads faster than facts. Once prices start falling, information becomes secondary to emotion. Fear spreads through headlines, social platforms, and group psychology. People react to each other, not data. This emotional contagion accelerates declines far beyond what fundamentals justify. Past crypto crashes showed how quickly sentiment flipped from excitement to despair. Facts didn't change overnight. Behavior did. When fear dominates, recovery becomes difficult because trust needs time to rebuild. This phase often catches optimistic investors off guard. They expect logic to slow losses, but logic rarely wins against crowd psychology. Understanding how fear spreads is crucial to understanding why collapses feel sudden, violent, and inevitable once they begin. History shows collapses feel obvious. Only after looking back, crypto collapses always seem predictable. The warning signs were there: hype, leverage, overconfidence, and ignored risk. In real time, they felt harmless. That's the trap. Markets disguise danger as normal behavior until it's too late. Every cycle convinces people that lessons were learned and systems are stronger. Then those assumptions are tested. History doesn't repeat perfectly, but it often rhymes. The challenge isn't spotting patterns afterward, it's respecting them before losses appear. Those who survived previous crashes weren't necessarily smarter, they were more cautious when others felt comfortable. Remembering that difference is critical in hype-driven markets. Hype doesn't create wealth. Survival does. Real success in crypto isn't built during explosive rallies. It's protected during unstable moments. Hype encourages aggression, but survival requires restraint. Investors who last across cycles manage risk even when optimism feels justified. They don't rely on excitement to guide decisions. Past collapses rewarded patience and punished overconfidence. This pattern hasn't changed. The market doesn't owe anyone smooth growth. It tests discipline repeatedly. Ignoring hype doesn't mean missing opportunity. It means avoiding unnecessary destruction. Survival allows participation in future growth. Collapse only feels shocking to those who assumed it couldn't happen again. Crypto hype is powerful, persuasive, and emotionally contagious, but